So we're going to proceed with the second problem. On the second problem, we're gonna evaluate the dividend, the definition of dividends, the types of dividends, and how it affects the company's owner equities. The first one is, what is dividend? We need to explain the chronological procedure of the dividend payment. So dividend is a payment made out of the firm's earnings to its owners in the form of either cash dividend or stock dividend. So these are the example of chronological procedures of dividend payment. The first one, you need to remember 4 types of date. The first one is declaration date. The second one is ex-dividend, and the third one is record date, and the fourth is payment date. What is declaration date? Declaration date is the date where the board of directors declares a payment of dividends. So a payment of dividend, they will declare, so they will give dividends for its shareholders. And ex-dividend date, we're gonna proceed with the ex-dividend date, and we're gonna start with the third first. As the record date, the record date is that declared dividends are distributable to people who are recorded as shareholders of this specific date. So after the firms declare the dividends and the firms declare the record date, 3 business days before the record date is called as ex-dividend date. So for example, if the declaration date is on January 15 and the record date is January 13, in order to for me to gain the dividend paid out by the firms, I need to buy the stock on the January 27. Ex-dividend date is the last date. The date which the seller is entitled to keep the dividend. If I buy the stocks on January 28 or later than January 28 or later than January 27 exactly, so I won't have the right to keep the dividend. So ex-dividend date is the date where I need to buy the date before I need to buy the latest date where I need to buy the stock in order to gain the dividend. So, in my example, if the record date is the 30th January, I need to buy the stock on January 27 because the ex-dividend date is 2 business days before the record date. Why is there ex-dividend date? Because stock transactions needed 3 days before the settlement. So in order for me to be recorded as shareholders in January 30th, I have to buy the stock on January 27, because if I buy the stocks on January 28, on the record date, I will not be recorded as the shareholders. I will go into the record book on January 31st. So that's why the ex-dividend date is important. And after the declaration, the record, and ex-dividend, we have the payment date. Finally, we gain the dividend on the payment date, where the dividend checks are mailed to shareholders of record. So there are better examples at Investopedia regarding the ex-dividend date. So this is a bit hard to explain. I've tried to explain it as simple as it is, but maybe you find it easier. If you find it easier to understand from the Investopedia, so please go kindly check the online resource of Investopedia. They made a great video about explaining the declaration date, ex-dividend date, and such as. So the second question is, the ABC Corporation is a consulting firm specialized in FMCG industry. The company has 10,000 outstanding shares with a market value of $66 per share. And following is the partial balance sheet information related to ABC Corporation. So they have a common share with $1 as par. They have 10,000 shares, so they have $10,000. Capital surplus, they have $200,000. Retained earnings, they have $290,000. So in total, the annual equity is $500,000. show the changes in balance sheet if the first one, the company makes 10% of stock dividend payment, and the second one if the company doing stock split for 2-for-1. So so we need to understand the outstanding shares first. They have 10,000 shares, and the second one is the market price, which is $66 per share, and par value of $1 per share. So in the first case, the company gives 10% of stock dividend, so it make the additional stock outstanding of 1,000 is coming from 10% times by 10,000 shares. So in total they will have 11,000 stocks, 11,000 outstanding shares, accounted to with a par of $1. The sum of these stocks is $11,000. So what is the capital surplus? Why is it going down into $265,000? Because if you look closely, they have a capital surplus of $200,000, right? And if they issue a share of $66 per share, so this is the price that the investors need to buy. This is the price of the share. So if I get the stock dividend, I would get $66 in my bank account per share for my dividend, for my stock dividend. So this is the assets transferred, the amount of asset transferred to the shareholders. The value transferred to the shareholders is $66. The part of this stock is $1, so the capital surplus is $65, right? And the time by $1,000. So in total, this is the expense that the expense of the capital surplus that the company gained. So they increase the capital surplus because the ownership of the stock increases. So the capital surplus is $65 per share, and they issued 1,000 additional stocks. So this is why the 200,000. This is why it is accounted to $265,000. So it's $200 and summed by $65 per share, times by 1,000 stocks, 1,000 shares. So the capital surplus is increasing, but why is the retained earnings is decreasing? If you look closely, the retained earnings is $290,000, and it decreasing into $224,000. So why is that? Because as you have learned that the dividend is paid out by in terms from net is. That is a result from net income. So in terms of they have a return earning of $290,000, and if they're going to pay a dividend of a stock dividend in terms of the capital surplus, it will decrease its return earnings. Return earnings is the amount of money that is going to be invested in the company, right? As the internal source of financing. But when the company pays a stock dividend, it will decrease the return earnings of the company. It will decrease the internal source of funding. So this is the money. This is the expense of the stock dividend paid out by the firms to its shareholders. So this is why that the amount is decreasing from $290,000 to $224,000. So if you can see right here, this is the market price times the additional stock outstanding is the expense of the issuance of the stock dividend. In total, it didn't change the owner's equity. It's the sum of the common stock, capital surplus, and the retained earnings. So it stays in the $500,000. So this didn't change the owner's equity. And we're going into the second scenario. What if the company made a stock split 2-for-1? So the shares outstanding will add into 20,000 stocks, but the part of the stocks will be half to $0.5 per stocks. And how this will affect the owner's equity? It didn't affect the owner's equity because the par is still the same, the capital surplus is also the same, and the return earnings is still the same. It's also the same. So the conclusion is that neither stock dividend nor stock split will change the amount of the owner's equity, but it only changes the component for each account on equity section. So neither the stock dividend or the stock split will change the amount of the owner's equities, only change the composition, change the component for each account on the equity section. And the last one is referring to the number of outstanding shares on the par value at point P. What will happen if the company doing a stock split as below: 4-for-1, 1-for-5, 3-for-2, and 1-for-3. So it's the same case as the above. If the first scenario, if the company made a stock split of 4-for-1, so the par will go into split into a quarter, and the outstanding shares will go in 4 times higher into 40,000 shares. You see right here. So there's a relatively easy logic to follow. The second scenario is if the company wanted to stock split into 1-for-5. So this means the value of 5 stocks now become the value of 1 stocks. So the par will increase by 5 into $5, and will multiply by 5, and the outstanding shares will be divided in. Will be a fifth of the earlier amount of the shares. And the third scenario is the 3-for-2. In this regard, we need to calculate the par. We need to 3-for-2 is 3.5. 1.5. We need to divide it into 1.5 of the earlier par, and the outstanding shares will increase. We need to multiply the outstanding shares to 1.5, multiply to 1.5, counted to 50,000 shares. And the fourth scenario and the final scenario is that 1-for-3. So the par of the stock per share will increase into $3, and the outstanding shares of the stocks will go down to a third, only accounting to 3,333 shares. So that's how stock split affect the par and the outstanding. But as a conclusion, as you have seen in the earlier problems, that it wouldn't affect the owner's equity of the stocks or the common stock or the capital surplus. No, it won't affect any of them. But a stock dividend will affect the component, only the component of the owner's equity, but the composition will change, but the amount, the sum of the owner's equity will stay the same. So that's how stock split and stock dividend affecting the composition of the owner's equity, or affecting the balance sheet of the firms. So this is the end of the tutorial session. We only have 2 problems to explain further. But if you want to gain deeper understanding, you could ask for your tutors in a more detailed manner, and you could also Google some terms or you could gain some knowledge from online resources such as Investopedia and some things, if you feel like that's the easier resources for you to learn. So that's all from me. Thank you for your attention, and good luck.